Manishi, great having you. Thanks so much for joining in. Before we talk about the wider India interest, Manishi, or the lack of it right now, would love to know what you made of this whole IndusInd saga, if I can call it that. I mean, if you've heard of the news, because in case you haven't, I mean, there is a declaration that they've done which has a 1,600 to 2,000 crore post-tax or pre-tax impact on net profit, which will be accounted for in Q4. What do you make of such a development?
Well, I mean, I wouldn't comment on this specific case, but I think it's a perennial problem with some of these second-tier banks, or even some of the non-banking finance companies that we have seen earlier. So, it is something that investors have to be mindful about. I have seen commentaries where, some analysts have said that IndusInd Bank is the next Yes Bank. So yeah, it's I think some kind of a generic problem that arises from time to time as far as the second and third tier banks are concerned. Earlier, it used to be a problem with the public sector banks. Now it's kind of, over the last few years, it has kind of come to the fore with the private sector banks also. So I think in these circumstances, it is preferable to stick to the large cap frontline banks, which have way better asset quality than the second and third tier banks.
Manishi, hi, good morning, Tamanna here. I think that's a very interesting observation when you bracket second tier banks, because today you're seeing an ICICI Bank responding positively, but I know you might not want to get into the specifics. Let me get the overview. What we're seeing is the aftermath of what is shaking up the US markets right now. And of course, that's playing out in quite a strong fashion in India as well. Do you think that this pain continues for us? We remain relatively unscathed, and the idea and the sense prevails that the domestic Indian equity market has its own factors, not just necessarily needs to be rocked by what's happening in the US.
Right. Let me summarize what's been happening. In fact, the current narrative is that of a potential US recession. How did it arise? Because investors are most concerned about the recent, the narrative of the Trump administration, that they may not be too concerned about a short-term turmoil in the economy and the market. Earlier, everyone was expecting that, okay, the US administration is business friendly, they're market friendly, and therefore, if they see the possibility of a serious market downturn, they would possibly provide a backstop. They would maybe temporarily, they would back away from, the kind of tariff war that they have unleashed. But it does not appear to be so right now. And that is the biggest concern. That, this whole uncertainty about the way the tariffs are going to be implemented, the kind of retaliatory pressures we are seeing, the counter punches, they would actually likely continue for some time. And if that is indeed the case, then the next hurdle, the next timeline to be watched out for is April 2nd, when the reciprocal tariffs kick in. And these reciprocal tariffs have an implication not just for Canada, Mexico, and China, but for all US trading partners, including India, where I think potentially the calculations show that the tariffs can go up by about 15 to 16%, and that's significant. So this time around, the tariff net is being cast much wider. They're also much higher compared to the 2018 episode. In the 2018 episode, throughout the year, we saw S&P 500 decline 15%. Asia ex-Japan declined 25%. Of course, at that time, it was more China and Korea. India relatively didn't suffer. India declined only about 6 to 7% in that episode. This time around, it may be different, because India is also being dragged into this tariff net, as we can see. So, near term would be volatile. There are hardly any hiding places, apart from high yield bonds, maybe US treasuries, and so on.
But even there, I think, Manishi, of course, what we've seen yesterday, right? With the markets correcting how they have, the cohort of people who wanted to move to safe haven have put in money on this policy-sensitive 2-year treasuries, right? And where the yields have dropped quite significantly as well. Are you, who's got the option of investing across multiple markets,
Right.
currently staying away from equities, Manishi? Is that what I'm hearing right now?
For the next month or so, I will certainly do that. I will possibly stay away from equities. My overweight positions, both personally and kind of recommendations to our clients, they have been in favor of the relatively cheaper markets in North Asia, particularly Greater China. There are some policy stimulus in favor of consumption that are emerging in these markets. Some of the Chinese tech platforms, they're also doing much better than the US Magnificent Seven. And we think it's likely to be so because the recent experience of the Chinese LLMs have shown that Chinese technical capabilities are monetizable, which was possibly not quite anticipated to this extent even a few months ago. So, I think, domestic consumption, some of the tech platforms, internet platforms, these are the ones we like in this part of the world. India incrementally is actually looking interesting after this 15 to 16% correction that it has suffered. Particularly in case of large caps, a few sectors, let's say financials, the frontline banks, I would say, some of the industrial names, they've actually corrected to such an extent that some incremental inflow could come back there, but it still remains a very careful stock selection market. One can't really paint it with a broad brush at this stage.
Fair point. Okay. Manishi, there is this tilt that or shift, if you will, in India towards consumption from the government side as well, right? After years of capex push. Not to say that capex is dead, but there was a push given to consumption. So therefore, my question is, if you're starting to see India interesting, large caps as it may be, is the bias different than the previous 3 years? Are you betting on consumer themes, discretionary staples, what have you? Or are you doing a mix with a tilt towards maybe economy and capex?
Right. I think the incremental tilt has to be towards consumption, particularly consumer discretionaries. Because, think about the kind of the bracket of the population which has got this tax benefit. This rupees 1 trillion tax benefit is going to the taxpayer, basically, up to 12 lakhs in India. And their incremental spending would likely to be in discretionaries, not so much in staples. So, I think automobiles, other consumer discretionary household appliances, these are the ones which one would have to take a look at very carefully, particularly those which have a strong earnings growth story and at the same time are reasonably valued.
Okay, Manishi, and sorry if I'm repeating this, but I would love to know. Let's assume somebody's got limited capital, right? And actually, not let's assume, everybody's got limited capital, right? Within consumption, is it towards discretionary, which a lot of people are saying could benefit by virtue of the tax cuts this time, and the pay commission hikes that come in Jan 2026, so on and so forth, right? So is discretionary the overarching favorite, or do staples come in as well? Because I mean, staples have this issue, right? The growth is not very high. Regional competition is stepping up. Why do you pay them 45, 50 times multiples?
I agree with you there. In fact, my overwhelming preference, if I were to disaggregate these two segments, would be in favor of consumer discretionaries.
Okay.
Discretionaries in preference to staples. There's no doubt about that.
Okay, and sorry, just trying to simplify this, Manish, so that people get a takeaway. And I'm not asking you to name stocks here, of course, but by discretionary, would it be air condition manufacturers? Would it be mobile back-end manufacturers, the EMS players? Would it be some of these financiers? How do you go about playing discretionary?
Oh, yes, of course. I mean, I would include that in that definition, the entire supply chain. So yes, household appliances, as you said, the manufacturers, the mobile back-end manufacturers, or even automobiles, auto components. So that's a very broad canvas to play from. But I think pretty much all of them would benefit from this consumption push that the government has implemented.
Okay, so I just want to go back to what you said, Manishi, about the equity fast for the next 1 month, so to speak. Just stay off equity for a bit. And for our viewers who are watching from an Indian perspective, then what are the best asset classes and options right now? Because let's give them something that helps, make that decision. What at this time when equity is looking a bit painful should you do? Should you sit still, keep the faith, look at other asset classes? What would you say?
Well, I think about a month ago, I was possibly on your channel and a few other peer group electronic media. I did talk about gold at that point of time. Gold has been a favorite for a while now, and you've seen how gold prices have behaved. But I would think in the current uncertain period, that would gold and silver possibly that should still be one of investor favorites. We're also seeing currency related turmoil, currency related concerns, and in times like these, those hard assets they tend to do better. They're also seeing significant interest from governments with various central banks in terms of purchasing bullion. Second, I would think that in times like these, cash is king. Money market funds, some of them have decent yields, maybe 4 to 5%, or maybe even higher in some cases. I would also talk about dividend yields. Dividend yields are difficult to come by in India, but there are lots of options and very good options in East Asia. Where I sit right here, there are state-owned enterprises, the SOE banks, some of the oil companies in China, which are yielding in the range of 6 to 9%. So there are options, no doubt, for capital preservation, which I think would be the supreme interest in the kind of situation that we are living in.
Very interesting. Manishi Raychaudhuri saying that gold is looking good right now. Gold is the exciting bit. From just on the tariffs perspective, and this is crystal ball gazing, knowing that things are changing every 24 hours. But if the Trump tariffs do come to pass, we see a full-blown trade war. What does this mean for the way the Indian economy is structured and the impact for us?
You see, I think as far as the Indian economy is concerned, the negative impact would be more on sentiment than on actual fundamentals. So there is a lot of research on this. Possibly the most prominent is by the Yale, budget lab, as they call it. And so they have talked about the potential increase in tariffs if the reciprocal tariffs come into implementation. And by their calculation, average Indian tariffs would increase by about 16%, which is one of the highest. So for China, that's slated to increase by about 13%. But Chinese tariffs have already increased by 20%. So in case of China, the worst may be behind us. So if the average Indian tariff for exports to the US increase by about 16%, that's a pretty strong outcome. But at the same time, if I look at India's total exports to the United States, that is hardly about 2 to 2.5% of the economy. So I think rather than the depressing impact on the economy, it would be more of a depressing impact on the sentiment, both sentiment as far as the financial markets are concerned and sentiment as far as corporate investment behavior is concerned. And that is what we have to contend with.
The negative sentiment is what we have to contend with. Unfortunately, no dearth of negative sentiment right now. Thank you so much, Manishi Raychaudhuri. Great to speak with you, as always.